So you want to invest in Web3, but you don't know what tokens to buy, you can use SwissBorg's thematics instead. They select a collection of the best performing Web3 tokens and rebalance them upon performance. So you don't need to worry about going all in on an absolute steaming turd. Sounds good to me. SwissBorg. Hello everybody, welcome back. I'll make this quick video about moving averages. So I've had a few requests about it, so I'll make it. It's available to all. It's not just unique to the Patreon, so don't worry about that. But I will highlight this as part of a training thing that I'll pin on my Patreon for people. I've made them in the past, but it's obviously got lost in the mix somewhere. So a moving average, just generally what it is, it's a smoothing out of the price action. So they're all correlated to the price. That's what it is. And you have different time frames, time intervals. So, I mean, starting from, you can customize them. They could be, you know, a 1 million day moving average if you wanted one. You probably wouldn't see one because there's probably not been a million days of trading. But generally, you know, you'd have anything from a 200 to as little as maybe even a 5 moving average. You also have EMAs, which are exponential moving averages, as well as simple moving averages, or just moving averages. Okay, even the humble Bollinger Band is basically a moving average, with the 20 moving average working in the middle, and then the outer bands being responsive and sensitive to volatility. But yeah, it's basically a moving average. So the ones I would have on my chart, and this is just me, because like I say, you can customize them, and you can customize them generally to do with how the chart or the price action responds to specific ones. Not all charts are equal in the way that they respond to moving averages. There are some which I find more useful than others. The 20 moving average obviously being the Bollinger Band Center being probably the most common one, and I'll probably say that if there was only one moving average to use, it would be that one, because the Bollinger Band strategy itself is a relatively decent and simple strategy based around one simple moving average, being the 20. But I would have a variety, and sometimes it looks a little confusing to people who don't know what's going on with them. But the ones I have on my chart, and I'll show you down here, and they're color coded. So I have the 200 simple moving average. I have the 200 exponential moving average. I have the 50 simple moving average, which is just MA, so simple moving average. The 50 exponential moving average. The 21 exponential moving average. The 10 exponential moving average. And then finally, the 7 simple moving average. So the reason I've got a combination of simple moving averages and exponential moving averages is because they both work. They all work, and the reason they work is basically because traders will have them on their charts, and they will use them to either buy the dips on when you come down to them. So buying the dip on an exponential or on a simple moving average is used as a support. I use them more than I don't really use fibs, but I would use them way more than anything like that. I'd use them more than any kind of trend line that's been drawn in on a horizontal or diagonal basis, because they move with the price action. And you can see the relevance, generally speaking, just on this chart. We're just looking at the most recent portion of this year's Bitcoin price action. You can see that there is some relevance to what's been going on. So since reclaiming the moving averages, using them as support, we broke through and had a very bullish rally all the way up to the 200 exponential, where it was actually used as a resistance for a period of time. Then we continued to be bullish and using the 10 exponential as a building block to try and make our way up, and then we failed and then broke down to use the 200 exponential again, but this time as a support. That's where a V-shaped recovery was formed. Now, like I say, just looking at the chart, you can see the relevance to the majority of price action hanging around these moving averages, whether it's a resistance or a support or a resistance, a support or a resistance, a support. So look, and then again, adding in the Bollinger Band Center being, like I said, a pretty important one itself, you can see that there's relevance to that as well. So that's a very important one to have. So another thing that you'll have heard probably would be people talking about golden crosses and things like that. A golden cross, in its basic term, is when a 50 moving average crosses a 200 moving average. The reason why that's important is because it's showing the strength of a trend continuing. Remember, these are all different time intervals of the price action itself. And so if you're in a strong trend, you would expect moving averages of the lower term timeframes to cross above the higher term timeframes and create what I call a rainbow spread, because they're all different colors and they're all spreading in the right direction. If they continue to point up and they diverge like what we see at the moment, it's showing a strong trend. Now, you don't need the moving averages to know that there's a trend going on. You can see that anyway. You can see what's going going on. But the reason you have the moving averages as well is because if you want to exit a trade at a resistance, you would do that. If you want to buy the dip on a support, you would do that. And the moving averages are giving us a good idea of where that's taking place from. Now, unlike using, let's just say, I don't know, maybe a horizontal trend line, which again I would use them. You would be looking at certain areas on the chart going, well, there's an area to buy from. Look, there's a fair bit of price action that's taken place around this area, and I will wait to buy that dip. But no, the 200 simple moving averages caught it before it got down there, and the reason for that is because lots of traders would look at that and they would say, well, look, as far as the trend is concerned, the trend is still trending up. Moving averages on the short term time frame still moving up. Moving averages are crossing above each other, still moving up. If I'm going to buy a dip, I'm going to use a moving average instead of a horizontal, because it might not come down to there. The first sort of major area to buy this dip from here would have been the 200 simple moving average. So you would have got your dip bought there rather than waiting for a horizontal area like this one, 18,800. You would have bought the dip, around 19,700, and you would have bought it on an educated guess that the moving average will act as a support rather than a horizontal, which probably coincides with a fib. This is probably a fib retracement in itself. Most horizontals do correspond to fibs, but you can see that clear as day on the chart here that would be an area that would be significant if we came down to it, but you might not get there because moving averages are going to be used as support most of the time, especially the lowest, the higher term timeframes. The higher term timeframes being the stronger moving averages to buy dips from, also the stronger moving averages to sell if you're moving up into them, depending on the strength of the trend, obviously. So I'm looking at this on a daily, but this would work on all time frames really to a different extent. You can see here that we came all the way down to a 50 exponential, got a big dip bought, and the 50, we were riding that a few times before we actually dipped our toes below it. Not perfect, obviously, but you can see the relevance of the moving averages, even on the 4 hourly. You could take it down to anything from a 1 minute, and you'll be able to see the relevance of it. This is a 5 minute. And you can see that, yeah, the 50 exponential has held it here on the 5 minutes. The 10 exponentials held it here on the 5 minutes, back down to the 21, riding up on the 10, 10, 10, 10, 10, 10, 10, 10, and look. So it's not perfect. It's certainly not perfect. But the reason we use them is to show strength of trend with divergences all crossing above in the right place, creating a rainbow spread. Look, just as another thing to say, I mean, the rainbow spread in a perfect sense would have the shortest term timeframes all the way above the lowest term timeframes, or the higher term timeframes. Sorry. So look, 200 simple, 200 exponential, 50, 50, 21, 10. So it's more or less perfect because the smaller term timeframes, being the 7 and the 10, are way above the 200s, which are all down here. This is showing a strength of trend as classic rainbow spread. So if we go to, let's just say, a chart that is probably struggling at the moment, so there's obviously quite a few. There's always a few, but we'll have a look at something like Atom, for instance, on, let's just say, the daily. It's a different, actually it's not too bad. What's not going to be good? There's got to be something around here. Okay, right. So Atom on the daily is very different to Bitcoin. We've got a 200 exponential sitting above us. That's going to be a resistance until broken. Okay. So unlike Bitcoin, where you're above all major moving averages, showing a very strong trend, and an opportunity to buy dips. On this instance, yeah, you can buy dips. You can buy dips on these ones down here, certainly, but you do have to be cautious as you approach the 200 exponential moving average. Higher term time frame is going to act as a resistance until we're above it. Once above it, you'd like to see a building block being made above that, and then what you'd see over a period of, well, probably weeks really, will be these moving averages crossing up as they are moving up towards the 200 exponential, and the 200 exponential would look something along like this. And then you would get a classic golden cross somewhere along the lines at around here. And then that golden cross would show strength of trend, and you would then take all these moving averages with a bit more confidence that there is going to be a continuation of the trend. Even if the price action comes all the way up here and you get really excited and you haven't bought the dip and we get a golden cross, it's very common to see a move all the way back down to test these moving averages to see if they are actually as strong as they appear. And these are the classic golden crosses that you'd really want to be picking up and buying from the moving average. And so when people say, where should I buy the dip from? I would say, I don't know. because I don't know where the moving averages are going to be at the time. This is the value of them, you see. So when people have like signals groups or tell you that this is there and this is this and this is this, I'm not saying that they're wrong, but you know, resistances and supports in the form of moving averages change on a daily basis. So if you're on a 5-minute chart, they change on a 5-minute basis. Buying the dip now is going to be different to buying the dip tomorrow or next week, and so on, because the dip will come down to a different area on the chart, meaning that with every moment that passes, really, these moving averages are evolving, and so is the area to buy the dip or to sell the resistance. Hopefully that's made sense to you. Like I say, you don't need to use the moving averages that I use. Different charts will give you different reads on different moving averages, and you will see what behavior suits that chart best. But for me, these are the ones that I would use. But alterations of this could be better, they could be worse. It's completely up to you. You got to find out what is has the most confluence for the chart that you're trading, because they all behave differently, although the strategy remains the same. Anyway, I'll leave it with you there. Thank you for watching. I hope you have a nice day. Take it easy.